Welcome to Invest with Neko B.
Please like and subscribe to our YouTube channel.
Welcome to the Neko podcast station.
Today we explain stocks, ETFs, and index funds.
Let us help you understand.
Sounds perfect!
Let's dive in.
What if I told you that being deliberately locked out of your investment account during the middle of the day is actually the greatest financial advantage you could possibly have?
I mean, it sounds completely counterintuitive, right?
Right. But today we're looking at something that affects literally anyone who wants to grow their money. And you know the feeling. You finally decide to start investing. You open up a brokerage app on your phone, you log in, and instantly you just hit this massive, intimidating wall of jargon.
Oh, the jargon is everywhere.
It really is. You see terms thrown around like stocks, ETFs, index funds, and if you're like most people, you probably just assume they're all different words for the exact same thing.
Yeah.
I mean, isn't it all basically just the stock market?
Well, the financial industry absolutely thrives on making the menu impossible to read. It keeps the barrier to entry high, and makes everyday people feel like they need expensive professional help.
Which they usually charge you a premium for.
Exactly. But beneath all that intimidating terminology, these vehicles actually operate quite differently. They have different structural costs, wildly different tax implications, and they serve entirely different behavioral purposes for your financial goals.
So our mission for today's deep dive is to shatter that wall of confusion once and for all. We've got a massive stack of sources today. We're talking beginner investment guides, incredibly dense SEC market architecture documents, and some really fascinating historical financial research.
Some really heavy reading in there.
For sure. But we're going to definitively break down the differences between stocks, ETFs, and index funds. Because understanding these differences, it isn't just about sounding smart at a dinner party. It is the literal difference between investing with total confidence and investing completely confused.
And honestly, getting this right could save you tens of thousands of dollars in hidden fees over your lifetime.
That is huge.
It's the ultimate bottom line here. Despite the complex plumbing, these investment vehicles all serve the same core fundamental purpose. They exist to help everyday people build long-term wealth. The trick is simply understanding the mechanics of each one so you can match the right tool to your specific psychological and financial situation.
Okay, let's unpack this from the absolute ground up. Before we can even touch the complex bundles and the automated portfolios, we really have to understand the basic foundational building block of the entire financial system.
Right, the single stock.
Exactly. I always like to picture a publicly traded company as a giant pizza. The entire massive pizza is the company itself, and one slice of that pizza is one single share of stock.
I love that visual.
Thanks. So if you buy 1,000 slices, you own 1,000 shares of that pizza.
Right, and to put some concrete math to that pizza analogy, let's look at a behemoth like Apple. Currently, Apple has roughly 15 billion shares outstanding in the open market.
15 billion. That is a lot of slices.
It is a massive pizza. So if you open your app and you purchase 100 shares of Apple, you own a mathematically tiny microscopic fraction of the company. You own about 0.0000007% of Apple.
Wow. Okay, so almost nothing.
Well, mathematically, sure. But that tiny fraction represents genuine legal ownership. I mean, it means you actually own a fractional piece of their manufacturing facilities, their software patents, and their massive cash reserves.
Right.
It even gives you official voting rights at their shareholder meetings and a direct claim to a portion of their profits, which they might periodically pay out to you in the form of a cash dividend.
And the appeal of buying those individual slices is incredibly powerful. The upside is heavily romanticized in our culture, We all hear the stories of the guy who picked the next Apple or Microsoft in a garage, held onto it, and just experienced gains that were genuinely life-changing.
Yeah, and the historical data validates why that dream exists.
Yeah.
I mean, look at the research in our stack. If you put $10,000 into Apple stock in January of 2010, when it was trading at just over $7 a split-adjusted share.
$7? Man, I wish I had a time machine.
Right. Well, that single, isolated investment would have grown to over $500,000 by early 2024. That is an absolute wealth-generating machine.
It's incredible. But there is a massive, often ignored flip side to that coin. While Apple was minting millionaires, other highly confident companies were doing the exact opposite.
Oh, absolutely.
Yeah.
Let's pull another historical example from the research to contrast that. Take that exact same $10,000 and put it into a massive, highly respected, seemingly inventable company called Enron in January of 2000.
Oh boy, Enron.
Yeah, you know where this is going. At the time, it was trading at $50 a share, and Wall Street just loved it. But by December of 2001, your $10,000 would be worth exactly $0. It's just gone. Both Enron and Apple were individual stocks. One made investors rich, the other completely wiped them out. When you buy single stocks, you're taking on heavily concentrated risk. You're putting all your chips on one specific slice of the market.
See, I have to push back on this whole romanticized idea of being a stock picker. Because we're told that stock prices are driven by supply and demand, and that demand is driven by underlying company fundamentals.
Right, in theory.
But wait, if I am an everyday learner, I have a full-time job, I have a family, I have a life, how on earth are you supposed to keep up with dense 100-page, 10K financial filings every single quarter to make sure the company I bought isn't hiding the next Enron scandal?
Well, the harsh reality is you can't. And you really shouldn't be expected to.
Thank you. It feels impossible.
It basically is. The data aggressively shows that even seasoned professionals, we're talking about hedge fund managers, with full-time analytical staffs, PhDs in mathematics, expensive Bloomberg terminals, they consistently struggle to reliably pick winning individual stocks and beat the broader market over a 10 or 20-year period.
So even the guys doing this 40 hours a week are failing at it.
Exactly. If the well-resourced professionals can't do it reliably, the everyday investor is at a massive statistical disadvantage trying to pick individual winners in their spare time.
So if I don't have a staff of PhDs, and picking one stock is a gamble that could literally wipe me out, how do I just buy a tiny slice of everything so I am protected? Because that logical question brings us right to the second major tool in our deep dive, the ETF.
Right, so ETF stands for Exchange Traded Fund. If an individual stock is a single slice of pizza, an ETF is the ultimate all-you-can-eat buffet.
I think of it as a financial variety pack. You buy just one single share of an ETF, but inside that one share, you instantly own a microscopic piece of tens, hundreds, or even thousands of different companies all at once.
What's fascinating here is the sheer efficiency of that bundling mechanism. A perfect example from our sources is the QQQ ETF.
Okay, I've seen that ticker before. What exactly is in it?
So this is a fund managed by Invesco, and its specific stated job is to hold the 100 largest non-financial companies listed on the NASDAQ exchange.
Got it.
When you purchase just one single share of QQQ, you instantly acquire a proportionate slice of Apple, Microsoft, Amazon, Google, NVIDIA, Tesla, and 94 other major companies simultaneously.
That is wild.
It really is. You achieve massive diversification with just one click. If one single company in that basket has a terrible quarter and its stock plummets, your overall investment is cushioned because the other 99 companies might be having a great quarter.
But mechanically, how do I actually buy this variety pack? Does it work differently than buying a regular stock?
The genius is right there in the name, the exchange-traded part. ETFs trade continuously throughout the regular trading day on secondary stock exchanges, identically to a regular individual stock.
So the price is just moving all day long.
Exactly. The price fluctuates second by second based on market demand. This gives you intraday liquidity. You can log into your app and buy or sell at 10:15 a.m. or 1:42 p.m. at whatever the market price happens to be at that exact second.
Oh, that's super convenient.
And furthermore, modern brokerage platforms allow you to buy fractional shares of an ETF. Even if one share of an ETF costs $400, you can invest just $5 and own a mathematically perfect fraction of that entire basket.
But wait, if an ETF is just a bundled basket of stocks, who is actually deciding what goes into the basket? Are there different flavors? It can't just be one giant basket for everything, right?
Oh, there are thousands of different flavors. They're designed to match whatever specific investment strategy you want to pursue. Well, you have sector ETFs that only hold companies in specific industries like technology, healthcare, or energy. You have bond ETFs focusing on fixed income.
Which just means you are investing in a basket of loans made to corporations or governments, right? Stuff that pays you a regular fixed interest rate rather than buying company ownership.
Exactly, spot on. You even have thematic ETFs that track hyper-specific trends like artificial intelligence or clean water infrastructure. But the most popular and statistically the most powerful flavor for everyday wealth building is the index ETF.
Okay, so instead of a human manager sitting in a corner office trying to pick the best stocks, an index ETF is just following a predetermined rulebook.
Precisely. An index ETF is programmed to blindly automatically track a specific market benchmark. The most famous benchmark being the S&P 500, which is simply a list representing the 500 largest publicly traded companies in the United States.
So there's no guy in a suit guessing what to buy.
No star fund manager at all. A computer algorithm just ensures your ETF basket holds all 500 companies in the exact right proportions. Whatever the S&P 500 does, your ETF does.
That sounds incredibly boring, but in a good way.
It is. Historically, despite world wars, massive recessions, global pandemics, that broad market index has averaged a return of around 10% annually over the long term.
Okay, here's where it gets really interesting. We've talked about stocks, we've talked about ETFs, and we've talked about an index ETF tracking the S&P 500. But our third major term today is the index fund, or more specifically, the index mutual fund.
Right, the classic mutual fund.
Well, wait a minute. If an index ETF tracks the S&P 500 and an index mutual fund tracks the S&P 500, aren't they just the exact same thing? I mean, why does the old school mutual fund industry still have trillions of dollars in it if I can just use a modern app to buy an ETF?
Under the hood, they're often identical. A Vanguard S&P 500 ETF and a Vanguard S&P 500 index mutual fund hold the exact same basket of underlying stocks.
So why do we have both?
The difference between the two is purely in the technical plumbing of how they are packaged, how they are priced, and how you trade them.
Okay, let's dig into that plumbing. Because we just established that an ETF trades all day long on an exchange, like a stock, but an index mutual fund does not.
Right. And that intraday trading feature of an ETF actually introduces a hidden structural cost called the bid-ask spread.
The what now?
The bid-ask spread. When you buy an ETF during the day, there is a buyer you willing to pay a certain price, called the bid, and there is a seller willing to accept a certain price, called the ask.
Okay, makes sense.
The market maker who facilitates that trade keeps the tiny difference between those two numbers. That little gap is the spread. But mutual funds completely bypass this chaotic intraday market. They do not trade continuously.
So they don't have a bid-ask spread at all?
None. Zero. Instead, all the buy and sell orders from millions of investors are pooled together throughout the day. Those orders are only executed once per day after the market officially closes at 4:00 p.m. Eastern.
Oh, so everyone waits until the end of the day?
Yes. The mutual fund administrators calculate the exact total value of all the stocks currently sitting in their massive basket. They subtract any liabilities and divide that by the number of shares. They arrive at a single, mathematically pure end-of-day price called the net asset value, or NAV.
NAV. Okay, I've seen that acronym.
Think of it like a group of friends settling a restaurant bill at the very end of a dinner party. Everyone pays exactly what the final math dictates. Every single person who bought or sold that day gets that exact same NAV price.
That's a great way to think about it. But there is also a difference in how much cash you need to get started, right? Because we mentioned you can buy a fractional share of an ETF for just a few dollars. Mutual funds often require a bit more commitment up front.
They do. While it varies by the specific provider, many index mutual funds require a minimum starting investment. Often, you need to bring around $3,000 to open the fund initially.
Which is definitely a barrier for a lot of beginners.
It can be, yeah. Though any subsequent investments you make after that initial chunk can usually be as little as $1.
See, I have to challenge this whole setup. Because if I am looking at my options as a modern investor, an ETF gives me instant trading, real-time pricing, zero minimums, and I can buy it on an app while I'm waiting in line for coffee.
True.
So why would anyone willingly choose an old-school mutual fund that forces me to drop $3,000 and then wait until the end of the day to see what price I actually got? Isn't faster, more flexible trading always better? I want my price right now.
If we connect this to the bigger picture of human behavioral psychology, faster is absolutely not always better. For a long-term investor, intraday liquidity is a very dangerous temptation.
Because it turns investing into a slot machine.
Exactly. When you have the ability to trade an ETF from your phone at 11:30 a.m., just because you saw a terrifying news headline about the economy, you are highly likely to make an emotional, reactive mistake.
You panic.
You panic. You try to time the market selling before a drop, or buying before a pop, which we already established is virtually impossible for professionals to do consistently, let alone the rest of us. Mutual funds, by their very clunky design, strip away that temptation entirely. You physically cannot panic sell in the middle of the day.
It forces you to take a breath and step away from the ledge.
It acts as an institutional guardrail for your own discipline. Mutual funds are the ultimate vehicle for a strategy called dollar cost averaging.
Oh, I've heard of that.
It's basically where you set up an automated system to invest a fixed amount of money from your paycheck, say, $500, on the first of every single month, directly into that index fund.
Set it and forget it.
Exactly. The system does it automatically, completely ignoring whatever the market is doing that day. You never check the daily swings. You just relentlessly accumulate shares over decades. In wealth building, boring is the strategy that actually works.
Okay, so the lack of control is actually a feature, not a bug. That makes a lot of sense. So, what does this all mean for the things that happen behind the scenes? Because we need to talk about the silent killers.
Oh, the silent killers.
Yes, the hidden mechanics that quietly eat away at all that wealth you are so disciplined about building. I'm talking about fees and taxes.
Those are the absolute silent killers of compounding returns. The choice between an ETF and a mutual fund isn't just about how they trade or how they protect you from your own emotions. It's heavily about their structural costs. The primary cost you have to look for on any fund prospectus is the expense ratio.
This is the annual fee the fund charges you simply for the privilege of keeping your money with them, right?
Yes. It is expressed as a percentage of your total assets invested in the fund. If you look at older, actively managed mutual funds, where a team of highly paid humans is actively buying and selling stocks trying to beat the market, they commonly charge expense ratios between 0.6% and a full 1%, or sometimes even higher.
Honestly, 1% doesn't sound like a lot. If I have $100, taking 1 penny feels like absolutely nothing.
It sounds totally negligible until you run the brutal long-term math. Our sources lay this out very clearly. Let's say you invest $10,000. Over 30 years, assuming standard market returns, an actively managed fund charging a 1% fee will cost you roughly $25,000 in lost growth compared to a near-zero fee index fund.
Wait, $25,000. That is a brand new car. That is a down payment on a house. Just completely evaporated because some fund manager wanted to make trades.
Evaporated entirely by fees. And it's because you aren't just paying that 1% every year, you are losing the compound interest that the 1% would have earned over the next 3 decades.
That is painful.
It really is. By contrast, passive broad market index ETFs like Vanguard's Total Stock Market ETF, ticker VTI, they can charge an expense ratio as shockingly low as 0.03%. It's virtually free to own a slice of the entire American economy.
Wow. Okay, we have to talk about the other silent killer taxes. Because our market architecture sources point out a massive structural difference in how ETFs and mutual funds handle taxes, specifically regarding a concept called tax drag. But before we get into the plumbing, what exactly are we being taxed on here?
We are talking about capital gains taxes. When you sell a stock or an asset for more than you originally paid for it, that profit is a capital gain. The IRS taxes that profit.
Fair enough.
Now, inside a mutual fund, the managers are constantly buying and selling stocks within their giant basket. Maybe they're adjusting their holdings, or maybe a bunch of investors panicked and wanted to cash out, forcing the fund to sell stocks to pay them.
Right.
When the mutual fund sells those stocks at a profit, the fund generates capital gains. And by law, the mutual fund structure requires them to pass those taxable capital gains directly onto you, the individual shareholder, at the end of the year.
Wait, so you could hold a mutual fund for 10 years, never sell a single share yourself, and still get hit with a surprise tax bill in December?
Unfortunately, yes.
That's awful. I like to visualize this like a leaky bucket. You have this great hose pouring water into the bucket. That's your compounding market returns over time. But if your bucket has holes drilled in the bottom of it, like high expense ratios and unexpected capital gains tax distributions, you are constantly leaking water onto the ground.
That is the perfect visualization of tax drag.
You are going to have to leave the hose running a lot longer and work a lot harder just to get a full bucket.
Exactly. Every time you have to pay taxes out of your investment account, you have less money compounding for the following year. Now, ETFs patch that specific hole using a very clever, highly technical institutional mechanism called in-kind creation and redemption.
Okay, break that mechanism down for us. Because in-kind creation and redemption sounds like something out of a theology textbook. How does that actually avoid taxes?
Well, the IRS generally taxes transactions when an asset is sold for cash. So instead of ETF managers selling stocks for cash when an investor wants to exit the fund, the ETF relies on a middleman.
Okay, who is the middleman?
They work with massive financial institutions called authorized participants. These institutions literally swap baskets of the underlying stock shares directly in exchange for ETF shares.
Oh, so they just trade the assets directly.
Right. Think of it like trading a vintage Charizard Pokemon card for a rare baseball card. Since you traded one asset directly for another asset and no actual cash changed hands, it is an in-kind exchange. Because no cash is involved in the swap, it does not trigger a taxable capital gain event inside the fund.
So the ETF utilizes a massive loophole to avoid generating the tax bill that the mutual fund gets permanently stuck with.
The data proves exactly how effective this asset swap mechanism is, too. According to our research, looking back at recent market years, a massive 52% of mutual funds distributed capital gains to their investors. Over half of them handed their investors a tax bill.
And for ETFs?
Only 7% did.
Wow.
That structural difference makes ETFs incredibly tax efficient. This is highly valuable if you are investing in a standard taxable brokerage account rather than a tax-sheltered retirement account like an IRA.
Okay, this has been an incredible breakdown of some seriously dense market plumbing. Let's synthesize all of this for you, the listener, so you know exactly which tool to pull from the toolbox for your own life.
Sounds good.
If you are looking for active control over your entry and exit prices, if you want the ability to trade intraday using fractional shares, and you want maximum tax efficiency because you're building wealth in a standard taxable account, the ETF is your absolute precision tool.
Claro.
But if you want to completely automate your wealth building, if you know you are prone to checking your phone and panic selling on bad news, and you just want to set up an automatic monthly deposit and let a system enforce your discipline, an index mutual fund is your best friend.
The most important takeaway from all these sources is that whether you choose the tax-efficient ETF or the behaviorally sound index mutual fund, as long as you are keeping your expense ratios incredibly low and investing in broad, diversified baskets, you are mathematically on the right path. The ultimate variable in wealth creation isn't the specific technical packaging of the fund. It is your personal discipline and the sheer amount of time you let compound interest do its heavy lifting.
Because time in the market always beats timing the market.
Always.
And that brings us to a final provocative thought I want you to mull over as you step away from this deep dive. We started by talking about how intimidating the financial world can be and how modern brokerage apps have seemingly democratized it. You can buy an ETF with a single, frictionless swipe on your phone while riding the bus.
Very true.
The financial industry spends billions of dollars engineering the user interface of those apps to make trading feel like a fast-paced, highly responsive video game. They give you the illusion of total second-by-second control over your financial destiny. But what if, in the complex world of long-term investing, the ultimate cheat code isn't having more control? What if deliberately choosing to have less control over your daily trades, locking yourself into a boring automated system that won't let you tinker with it, is actually your greatest possible advantage?
That is a fascinating way to look at it.
Thanks for joining us on this deep dive. Keep asking questions, keep looking past the jargon, and we'll see you next time.
That's a wrap for today. See you tomorrow with another lesson.
Don't forget to like and subscribe. See you then.
The information provided on this podcast is for educational and informational purposes only and should not be considered financial, investment, or legal advice. I am not a financial advisor, and the strategies or assets discussed may not be suitable for your personal financial situation. Investing involves risk, including the loss of principal. You should always consult with a licensed professional before making any financial decisions.